The Federal Reserve will be having a meeting on Tuesday and Wednesday to determine if they are going to rise interest rates or not. Here are a few ways it can affect us. Increases in the cost of borrowing. Interest rates hikes can result in an increase in the cost of borrowing, including mortgage rates, car loans, and credit card rates. This can make it more difficult for individuals to borrow money, which can lead to decreased spending and economic growth. Impact on savings. Interest rate hikes can also impact savers, as banks and other financial institutions may increase their saving rates in response to rising interest rates. This can benefit savers, but it can also put pressure on borrowers. Impact on inflation. Interest rates hikes can impact investments, such as bonds and stocks. Rising interest rates usually reduce bond prices and increase stock market volatility, which can have a significant impact on investor portfolios. Impact on inflation. Interest rate hikes can help to control inflation. When the Federal Reserve increases interest rates, it makes borrowing more expensive, which can slow down the economy and help to prevent inflation from becoming too high. However, higher interest rates can also lead to a decrease in consumer spending and economic growth. Overall, interest rate hikes can have both positive and negative effects on individuals and the economy, depending on the circumstances. Thanks for watching. Please like and subscribe.